Okay, before we get into anything technicals, let me share something real quick. So last semester when I was working on an organizational project where we had to manage a budget for a small event, we had receipts, we had an Excel sheet, we thought everything was fine. But when we reviewed it at the end, the number didn't match. Someone recorded a payment twice, someone else forgot to log a reimbursement, and the worst part is we only found out at the very end, but it was too late to fix things properly. It was honestly stressful, and the reason it happened was simple. We had no system, no checking process, no one reviewing anyone else's work. Now, imagine that, but multiply it by 1,000 or a million. That's what happens inside real companies. Every single day, millions of transactions, hundreds of accounts, dozens of departments are recording financial data. And if you look at any major company, financial scandal, maybe like Enron, WorldCom, or even smaller local case, the common thread is always the same. The numbers look fine on the surface, but no one was really checking the structured process and no independent verification. So here are the questions. How do we actually make sure that a company's financial statements are accurate and can be trusted? If you are a bank deciding whether to lend money or an investor deciding where to put your savings, how do you know the numbers are real? How do you know someone didn't just make them look good? That's exactly the problem that auditing was designed to solve. And here's the key insight. An audit is not just someone checking the books. It's a structured, multi-page process with specific tools, specific methods, and specific goals at every step. It's not random, it follows a very clear logic. You plan first, you test at the second, and you wrap it all up at the end. And each phase has its own purpose, its own techniques, and its own standards. So today, that's exactly what we're going to walk through together. We have three main sections. First, audit planning. It's about how auditors prepare, understand the client assess risk, and set their strategy. Second is audit testing, the actual field work, checking controls, verifying transactions, and examining the account balances. And the third is audit completion. It's about how auditors wrap everything up, review final evidence, and issue their opinion. By the end of this video, I want you to walk away with one thing, a mental map of how an audit actually works from day one to the final report. So next time, when someone says the company got audited, you'll know exactly what that means, what the auditors were doing, and why it matters. Alright, let's get into it. Let's start with those pictures. The audit process is broken into four phases. Phase 1 is planning and designing the approach. Phase 2 involves testing controls and transactions. Phase 3 is running analytical procedures and testing account balances. And Phase 4 is completing the audit and issuing the report. Today, we're going deep into all four starting with Phase 1. What is audit planning exactly? Think of it this way. Before a doctor performs surgery, they don't just walk in and start cutting. They review the patient's history, run tests, assess the risks, and plan the procedure. Audit planning is exactly that for auditors. Audit planning is the process of developing an overall strategy and deciding how the audit will be conducted. The goal is to make sure the auditor gathers enough of the right evidence and does it in an efficient and effective way. Without proper planning, you either do too much work and waste time or miss important areas. Neither is acceptable. Now, audit planning itself has 8 steps. Let's go through into step 1. Accept the client and do initial planning. The auditor first decide, do we even want to take on this client? Is there anything risky about working with them? Then they set the scope and begin organizing the audit team. Step 2. Understand the client's business and industry. You can audit what you don't understand. Auditors need to know what this company does. Who are their customers? What regulation apply to them? What's their competitive environment like? Step 3. Assess client business risk. This means like asking, Is there anything about how this company operates that could lead to error or mispresentations in its financial statement? I give you this example of a fashion retailer that depends heavily on seasonal trend. If consumers taste shift fast, the company might be stuck with overstock inventory, and that creates a real risk that the inventory will be overvalued on the books. Step 4. Perform preliminary analytical procedures. Before doing any detailed testing, auditors run a quick scan, looking at trends, ratios, and comparisons to spot anything that looks unusual. This helps them figure out where to focus their attention. Step 5. Set materiality and assess audit risk. We'll go deeper on this in a minute, but basically, the auditor decides what threshold of error is significant enough to matter. Step 6. Understand internal control and assess control risk. Auditors look at the company's own system for preventing errors and fraud and then judge how effective those systems actually are. Step 7. Gather information to assess fraud risk. Are there any red flags that suggest someone might be manipulating the numbers? And the last one is the step 8. Develop the overall audit plan and audit program. This is the final output of planning a detailed document that describes exactly what the auditor will test, when, and how. Let me zoom in on step 1 a bit more. Initial audit planning. Four things are happening here. First, client acceptance and continuance. Basically, should we work with this client? Is there anything that makes them too risky to audit? The second, identify why the client needs the audit. Is it required by law for investor, for a bank loan? This affects how the audit is scoped. Third is reach an agreement with the client. Both parties need to understand the scope, timeline, and responsibilities. And fourth, develop the overall audit strategy, a high-level plan for how the team will approach the work. Now we move into the step 2, understanding the business. It covers 4 key areas: the industry and regulatory environment, the nature of the entity and its operation, its objective and strategies, where is the company trying to go, and the internal control environment, how well does the company manage its own risks. All of this context helps the auditor spot where problems are most likely to occur. Now, client business risk is a concept worth pausing on. It's defined as the risk that the client will fail to achieve its objective, and the auditor's primary concern is whether that failure shows up as a material misstatement in the financial statements. Going back to our fashion retailer example, if consumer preferences shift quickly, the company might end up with unsellable inventory. That inventory might still be recorded at full value on the balance sheet, but in reality it needs to be written down. That's a material misstatement, and it came directly from client business risk. Now it's preliminary analytical procedures. Are the auditors first look at the numbers. The auditor isn't verifying anything yet. They're just scanning. They use tools like ratio analysis, year-over-year comparisons, and budget versus actual comparisons. The goal is to identify anything unusual, a ratio that looks off, a trend that doesn't make sense, and flag those areas for deeper testing later. Alright, now it's materiality. This is one of the most fundamental concepts in auditing. Materiality is the threshold that determines what counts as significant. If a misstatement is below the materiality level, it probably won't change how users of the financial statements make decisions. If it's above that threshold, it matters. There are 3 types of the materiality. The first is the planning materiality, is the overall threshold for the whole financial report. For example, if an auditor sets planning materiality at $500,000, then any single error below that might not be worth pursuing. The second is performance materiality, is a set lower as a buffer. If planning materiality is $500,000, performance materiality might be $350,000. It's about 70%. Why? Because there might be multiple smaller errors across different accounts. Setting a lower threshold ensures those errors don't quietly add up past the planning materiality level. And the last is specific materiality. It applies to high risk areas even if overall planning materiality is $500,000. Certain sensitive disclosures like related party loans or executive compensation might have a much lower threshold, say $100,000, because those are areas where even small errors are significant. Now, let's talk about the audit risk model, one of the most important frameworks in auditing. The formula of audit risk is audit risk equal to inherent risk times with control risk and times with detection risk. Let me break down its component. Inherent risk is the risk of misstatement before you even consider whether the company has control in place. Think of a tech startup with complex revenue recognition, multiple subscription tiers, bundled service. The accounting rules for that are genuinely complicated even without anyone trying to manipulate anything. Errors are likely. That's high inherent risk. Second is control risk. It's the risk that the company's internal control fails to prevent or detect an error. Imagine a retail company that doesn't do regular inventory counts and has no access restrictions to the warehouse. Their controls inventory are weak, so there's a high chance errors go undetected internally. And the last is detection risk. It's the risk that the auditor's own procedures miss a misstatement if the audit team is under time pressure and uses too small a sample size. They might not catch error that exists in the population. The key takeaway is when inherent risk and control risk are high, the auditor must push detection risk lower, meaning they need to do more extensive, rigorous testing. It's all a balancing act. There's one more important relationship to understand. Materiality and audit risk move in opposite directions. Higher materiality means lower audit risk because you are saying only big errors matter. So the chance of missing something significant is lower. Less detailed testing is needed. Lower materiality means higher audit risk because you are saying even small errors matter, which means the chance of the auditor missing one are higher, where extensive testing is required. This inverse relationship is critical for designing the audit approach. Now we move into phase 2 and 3. It's about audit testing. This is where the actual fieldwork happens. The plan is in place. Now the auditor go in and start gathering evidence. There are two main categories of tests. There are tests of controls and substantive tests. And substantive tests break down into three types: test of transactions, analytical procedures, and test of detail of balances. Let's go through to each one. The first one is about test of controls. The purpose here is not to check dollar amount. It's to check whether the company's internal control system is actually working the way it's supposed to. Think of internal control as the rules and system the company has in place to prevent mistakes and fraud. The auditor's job is to test whether those rules are actually being followed. For example, does the company require manager authorization before recording a transaction? Are the supporting documents complete? Are the numbers in the record mathematically correct? Are amounts posted to the right accounts in the general ledger? Auditors test this by observing procedures, inspecting documents, and sometimes performing the controls themselves to see if the outcome matches. We move into the substantive test. Substantive test. This is where the auditor shifts focus from process to actual number. The purpose of substantive test is to detect dollar misstatements, error that directly affect to the accuracy of the financial statement balances. There are three types and we'll walk through each one. Now, the type 1, substantive test of transactions. Here the auditor is verifying individual transactions. The focus is on three questions. Did this transaction actually happen? It's about occurrence of objective. Was it recorded? It's about the completeness. And was the amount correct? It's about the accuracy. A practical example is about The auditor takes a sample of recorded sales and traces each one back to the original shipping document. Did the goods actually shipped? Does the invoice amount match? This confirms the sale really occurred and was recorded correctly. Now we move into the type 2. It's about substantive analytical procedures. Instead of checking individual transactions, the auditor steps back and looks at patterns and relationship in the data. The goal is to identify anomalies, things that look unusual compared to what you expect. A simple example is comparing gross profit margin year over year. If gross profit suddenly drops from 40% to 22% while revenue actually went up, that's a red flag. Something unusual happened with cost or revenue recognition and it needs to be investigated further. One thing worth highlighting, analytical procedures are used in all three phases of the audit: planning, testing, and completion. But the primary purpose is different each time. In the planning phase, they help you understand the client business and identify areas of potential risk. In the testing phase, they can actually reduce how much detailed testing you need to do. If the numbers look consistent and reasonable, you might need fewer samples. In the completion phase, they serve as a final check. Does the overall picture of the financial statement make sense? Now, we move into the type 3 test of detail of balances. This is the most direct form of evidence. The auditor is directly verifying the actual dollar balances in specific accounts. Three things the auditor is checking: does the balance exist? Does the company have the right to it? And is it valued correctly? The example, for account receivable, the auditor sends confirmation letter directly to customer asking them to confirm what they owe. If the customer confirmed $50,000 but the company recorded $80,000, it is something's off. For inventory, the auditor basically counts items in the warehouse and compares that count to what's recorded in the system. For account payable, the auditor examines vendor statements to verify what the company actually owes to suppliers. So, why audit testing is matter? So, what does all of this matter? Every test the auditor performs generates evidence, and that evidence is what supports the final audit opinion. Without it, the auditor is just guessing. The combination of testing control, verifying transactions, running analytical procedures, and confirming account balances together. They build audit assurance. They give the auditor enough confidence to say, yes, these financial statements are fairly presented, or flagged where they are not. Alright, we're in the home stretch. Section 3, Audit Completion, which is for the phase 4. At this point, all the major testing is done. Now the auditor needs to do final checks, pull everything together, and issue the report. There are 6 steps in the completion phase. Let's walk through them. Step 1, Review of Contingent Liabilities. A contingent liability is a potential future debt, something that might become an obligation depending what happens. The keyword is potential. Example, lawsuits that haven't been settled yet, tax dispute with the government, product warranties, or outstanding credit agreements. If the change of this liability materializing is probable and the amount could be material, it must be disclosed in the financial statement. To find this, auditor will interview management, review correspondence with tax authorities, examine the minutes of board meetings, analyze legal expenses, and get written confirmation from the company lawyers. Step 2. Its subsequent events, governed by auditing standard SA 560. The issue here is that things can happen after the balance sheet date that affect the financial statements. The auditor is responsible for reviewing events from the balance sheet date all the way to the date of the audit report. There are 2 types of subsequent event. Type 1. Events require an adjustment to the financial statement. For example, if a major customer files for bankruptcy right after year end that directly affect the account receivable balance, the auditor needs to make sure that balance is adjusted. The type 2 events only require disclosure. You mention them in the notes but you don't change in the number. For example, If the company issues new bonds or announces a merger after the balance sheet date, that information needs to be disclosed so users know what is happening. Now we move into the step 3, accumulating final evidence. At this stage, the auditor runs final analytical procedures to make sure the overall picture of the financial statement still makes sense. They also evaluate whether the company is a going concern, meaning can the company realistically continue operating in the near future. They also review the annual report and any other document being published alongside the financial statement to make sure there are no inconsistencies, and finally they obtain the management representation letter. The management representation letter is worth focusing on for a second. This is a formal written statement from the company's management to the auditor. It's provided at the end of the audit. Management is confirming two things. First, that they take responsibility for the accuracy and completeness of the financial statements, and second, that they are given the auditor all relevant information, nothing was hidden or withheld. Why does this matter? Because if management letter claims they forgot to tell the auditor something, this letter is evidence that they represented everything was disclosed and it's a safeguard. Now we move into this step 4, final evaluation and opinion issuance. The audit now reviews all the evidence collected throughout the entire audit by cycle, by account, by objective. They estimate the total misstatements found across all accounts and assess whether the overall audit risk is acceptable. Then they assess the financial statement as a whole. Does everything make sense? Are the numbers consistent? Are the disclosure adequate? After all, they form must be their opinion. Now is a step 5, is issuance of audit report. If the auditor is satisfied with everything, no significant issues, financial statements are fairly presented, they issue a standard unqualified opinion. That's the clean bill of health, the best outcome for the client. If there are exceptions, maybe there's a scope limitation or the financial statement aren't presented fairly in a specific area, the auditor will discuss with the client before deciding what type of opinion to issue. Now it's the last step for the completion audit is step 6. It's about communication with a management or governance. The auditor communicates their key findings, any indicators of fraud, any legal issues discovered, and any significant weakness in internal control that were identified during testing. They also issue what's called a management letter. This is separate from the audit report. It's more of an advisory document. It contains practical recommendations to help the company improve its processes, controls, and financial reporting going forward. Think of it as here are our opinion on your financials and here's how you can do better next time. Alright, let's bring this all together. We start with a simple problem. How do you actually know if a company financial statement can be trusted? And the answer is a structured, well-designed audit process. Planning is where you lay the foundation, understand the business, assess the risk, set materiality, design your approach. Testing is where you gather evidence, check controls, verify transactions, run analytical procedures, and confirm balances. Completion is where you finalize everything, review contingencies and subsequent events, accumulate final evidence from your opinion, and communicate with your findings. Each phase fits into the next. The quality of your testing depends on the quality of your planning, and the quality of your conclusion is depend on the quality of your testing. And here's the lesson I hope you take away from this. Auditing isn't bureaucracy. It's not just ticking boxes. It's a system designed to protect the trust that investor, banks, employees, and the public place in financial information every single day. When it's done well, it works. When it's skipped or done poorly, well, that's when we get the scandals. So that's the audit process. Thank you so much for listening, and we're happy to take any question.